Terry Sawchuk is with me, Sawchuck Wealth. And Terry, first of all, good for you being here. Thank you.
Good morning, Steve. Good to be here as always.
Always a pleasure. So here's the thing. I looked at the things you sent me today. So some of the Fed, because you have Fed satellite offices, for lack of a better term, I guess, and some of the Fed offices and officers are saying we've already entered this recession. What do you think? What are you seeing? What do you believe?
Well, the Atlanta Fed has been releasing data that gives estimates as to what they think second quarter GDP was going to be. And about 6 weeks ago, they estimated it to be at 2.5%. As of this week, they've lowered it to negative. And so by technical definition, if you have first and second quarters consecutively negative GDP, that's a recession, right? So on a technical level, they're telling us, that it's likely we're already in a recession.
Well, that's exactly right. But why would they go from plus 2.5 to negative? What was the change from just 6 weeks ago? I mean, what happened?
Leading economic data is falling off a cliff, right? So sales are down. CEO interviews are suggesting that they're seeing a big drop in activity. You're seeing a bunch of layoffs in the tech space. I mean, a bunch happened in the last 30 days. So you're starting to see the manifestation of a pretty significant decline. And, the scary part, Steve, in all of this, from a market standpoint and just overall economic activity, I guess, is that if you look at the analyst estimates for S&P earnings, they're still predicting growth. And so there's a huge disconnect between what Wall Street analysts have been telling us they think is going to happen versus what's actually happening on the street. And so I think the next leg down is what they call an earnings recession.
Well, here's here are a couple of things to consider. First of all, we saw a lessening of demand on gasoline. They found the breaking point somewhere just north of $5, right? So that impacts the economy. I've also been monitoring. This is kind of something new for me and a little bit weird. Bear with me on this, Terry. But I've been watching rail traffic. Right, rail traffic is down several points, and why that's important is because that means that freight isn't being shipped at the rate it was a year ago, which means goods aren't being sent to be sold at the market, whatever they might be. It might be hard durable goods, could be fruits and vegetables, doesn't matter. Freight is down because prices have gone so high that they've found the breaking point. So if this recession comes now and wages remain about where they are, we could head into a very rough patch, couldn't we?